Welcome to Investors Hangout once again. Every week we talk about investment issues, try and help you understand issues that you face with your savings and investments. We also try and take as many questions that you may have. Today we are going to talk about asset allocation and financial planning and how do professionals deal with it, how do they approach it. And this is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Today, to get a gain from the perspective of a professional fund manager, today we have with us Shravan. He manages the fund of fund platform at Birla Sun Life Mutual Fund, Aditya Birla Sun Life Mutual Fund. And I'm going to seek his views and opinion that how he starts his day and how he goes about, what is the thinking behind the asset allocation, the science and the art of doing the job. How do they approach it, and what is guiding those, what are the guiding principles, because everybody has to, it's a key decision which every investor has to take, that where to put his money, to be putting in equity, to be putting in fixed income. And when you entrust your money to somebody who makes a living out of managing your money, how does he think? And maybe there might be some learning from it. So Shravan, welcome to Investors Hangout.
Thank you, Dhiren.
I want to understand, what are your financial planning funds?
Yeah. So financial planning funds is a simple set of three funds which does what a normal financial planner does. So you go to a financial planner, he says X amount has to be equity, X amount has to be debt, X amount has to be gold. We just created this set of basket of funds and put it on a platform. So we got three funds: aggressive plan, a conservative plan, and prudent plan, and each of them has a defined allocation. So in aggressive plan, for example, we have 70% equity, we have about 10% debt, 15% liquid, and 5% gold, and that's what a financial planner gives. Now, so you have this plan with you. Now, on that, you need to populate with an asset class. So globally, people typically go and buy ETFs, which are index oriented. But India, because there is an opportunity to create alpha, so we decided that we should go ahead and invest into funds. And we go and select the best of breed funds within this category. So if you take,
they may not necessarily be Aditya Birla Sun Life Mutual
not
Fund
at all. So it's an open-ended fund. So we actually invest across various fund houses, and a part of it comes into Birla Sun Life by virtue of the performance which the fund brings on the table. But we have a max allocation of 35% we can invest into Birla funds. But it's an open architecture.
Okay.
So we evaluate the funds, and we populate these particular funds with these allocation, and then. So apart from allocation, there is a rebalancing, which is very important. So most of the investors, because of tax issues or because of timing issues, etc., they're not able to rebalance the funds. So these funds get rebalanced on a regular basis. So there is a,
how regular is that regular?
So it's at least on a monthly basis it gets rebalanced. But before that, if there is a pop which is happening in the market and because of which the asset allocation is changing rapidly, then the rebalancing can be faster.
Yeah. Okay. Besides this, you also have two actively managed. One is the active debt fund, and the other is the active equity fund. How do you go about? I was curious about the active debt fund. That you have various kind of debt fund which you emphasize. What is the goal of this fund, and how do you go about choosing it? And how it changes in different complexion of the market?
So the goal of the fund is, again, it is actively managed. It goes across various fund houses because we believe that no one fund house has the skill set required to run across duration, across credit, across short term, long term, etc.
Different companies will have different strengths.
Different companies will have different strengths. So it is to pull in these strengths together into a particular fund. That's where active debt comes into picture. And we try to gauge the market opportunity. So if the market is good for capturing duration, so we go and invest in, let's say, long duration fund, gilt funds, income funds, kind of a thing. If the juice is out in terms of interest rates going down any further, then we go and hide into short-term funds or let's say credit funds. So that's where this active
what is the
debt
periodicity of devising this strategy?
So this strategy once defined, so it's typically for a 6 months to 1 year kind of a
the
view.
tactical changes, like Will you be doing it every 3 months, every 6 months, or
Yeah.
on an ongoing daily basis? There won't be much change.
No,
Right?
daily basis there's not much change. So in fact, if you see some of the funds which we have been holding across equity as well as debt is for a few years that
No.
we've been holding, right? So uh, we look at the fund on a regular basis, the strategy on a regular basis, but the change may not happen significantly. So, for example, interest rates were on a downward spiral since the last 3 years. So it's only June of last year we have taken a call saying that a part of the allocation has to be moved from duration to credit, and that dedicated allocation has moved to credit, and it's been sitting for over last 1.5 year, and then we are,
Can
we
you,
have,
for our
yeah,
for our viewers, explain duration and credit?
yeah,
I get it, but explaining it and so
yeah,
that they have a superior understanding
yeah.
of. Yeah.
Yeah, that's good. So duration is nothing but if there is a downward trend in the interest rates, the asset values increase. Asset values of debt instruments also increase, and hence it's better to participate in those funds which are invested in papers which are long tenure.
Longer maturity.
So if any fund house, they lend money to a corporate or a government
Government
through
bonds.
GSEC,
Yep.
GSEC bonds. So you can lend it for 1 day, you can lend it for 3 days, you can lend it for 1 year, you can lend it for 10 years, right? So if the interest rates are downward spiral, you go and lend it to the government for 10 years, so that when the interest rates come down, your value of this 10-year asset which you're holding
Because
goes
your
up
entitlement will be for a longer
for a longer period of time.
longer period of time, higher interest rate.
Absolutely.
Okay.
So once you play, so you need not lend it for 10 years and just sit tight. After 6 months or 1 year, when you think that the interest rate cycle has not come out, you can remove the money from that 10-year bucket and give it to a shorter tenure one, which is 1 year or 2 year kind of a thing. So that's where the movement happens from long duration to a short duration. So that's where the duration comes into picture. In terms of credit, I think credit is a beautiful product which I think the mutual fund industry has created over the last 7-8 years. Credit is purely giving it to corporates, but these corporates are ones which pay you higher yield. So government, for example, today 10-year GSEC is at
So
6.7%,
these are based on the credit rating of their.
based on credit rating of the companies.
So lower rated bonds come out yield
Yeah,
higher return.
yield higher returns, and the tenure of this is to extent of 2-3 years, and hence the volatility which you see, the movement of the NAV which you see is lower compared to, let's say, a 10-year paper, and hence credit funds are suitable for a kind of period where you need low volatility, and you would need, let's say, 200 basis points, 250 basis points higher return compared to a GSEC. So it's a play within duration and credit which you play. So duration works well when there is a fall in interest rates. Credit works well when there is a flattish interest rate or upward movement. So that's where active debt goes and allocates money to duration when there is a downward cycle, and to credit funds or shorter duration funds if there is a flattish or a upward trend which you see in interest rates.
So, and how do you go about choosing fund for your actively managed equity fund of fund?
Yeah. So
That is something which we do at Value Research, but I would like to
absolutely.
understand your thinking.
So I confess that most of the things which I learned are from Value Research, and it's been a great inspiration and learning
Oh,
vehicle for
great to
me
know that.
for quite some time. So we use both qualitative and quantitative process. So we allocate 2/3 of the weight to the quantitative process and qualitative process, and 1/3 of the weight to the quantitative process. What we do is every month we look at the entire bunch of 400 odd funds, and we try to look at the top 50 funds and see which are doing well, which are not doing well.
Across categories.
Across categories,
Large cap,
large
mid
cap,
cap,
mid
sector
cap,
funds,
multi cap,
thematic
everything.
funds,
Yeah,
everything. Okay.
because in the data it gives you some information which you might not be viewing. So we view the funds, then we go and interact with the fund managers individually, say seeing if there is a opportunity to participate in, and then if there is an opportunity to participate in, we get approval internally through our investment committee, and that fund is parked. So whenever tomorrow an opportunity comes, we go and invest. For example, last month we have taken exposure, small amount of exposure to pharma fund, and this has been approved about 2 years back. But we have taken exposure is because we thought the downward cycle of pharma is over, and hence we would want to take some part of the exposure and limited exposure to this particular fund. So that's why the fund is get parked after the investment committee approval is done, and then the allocation is done whenever the opportunity gets created in the portfolio. So these are reviewed on a regular basis. So on a monthly
So
basis, we
you
run
will
the
have,
screener.
assuming that in this fund you will have 5 funds or
Yeah,
4 funds.
yeah,
3 of them are diversified
yeah,
fund. They could be large cap, mid cap, small
yeah.
cap, anything. And within them there will be a pharma allocation.
Right,
And here now you are adding a independent pharma fund as well.
right, right.
what drives how much do you
Yeah,
do it, and
yeah. So we follow the core satellite approach. We invest 50% at least has to be there in core funds. The core funds are nothing but large cap funds where you track the index. Even if let's say markets go for a tailspin, you don't get hit by the portfolio so much in terms of the alpha drawdown. So hence we invest 50% at least on the large cap funds.
50%
50% is there.
is mapped to the
50%
index.
map to the index. 50% is where we take active
But
bets
through actively managed funds.
through actively managed funds. So we believe that for the next 10 years at least, Indian market can create that kind of alpha, compared to the global markets, where we see that opportunity of active funds is there. In the rest 50% is where we go into all these managers who deviate from the benchmarks, be it multi-cap funds, be it sectoral funds, be it thematic funds, etc. Sectoral funds, we are very, very cautious about taking it. Only in a downward cycle we take an exposure because it's very difficult to get in and get out of a sector fund
Yes.
in terms of valuations. But the rest of the 40-50% of the portfolio, which is satellite funds, are mostly into diversified funds. And currently we are playing it with, or rather last 3-4 years we're playing with multi-cap funds, which as again a new vehicle which has been created from the mutual fund stable, going between large cap and mid cap. So the essence is that select a fund. So when you're selecting a fund, it should be right, and you should be playing for longish period of time, and then having confidence in the manager that he can deliver it over and above. So that's where the selection process comes in. The qualitative approach, which is how good is a fund house, how good is a fund manager, the vintage of the team, how big is the team, etc., comes into picture. And then quantitative is just a small aspect of it, wherein is the consistency there, has he changed the fund, the stocks in the right manner, etc. But broadly, we believe that 50% core, 50% satellite is something which has worked for us for the last decade. I think that's the strategy which we allocate across our portfolios, be it 70% equity or 20% equity. That's the strategy which we follow in the funds.
Thank you very much for your sharing your experiences and perspective and insights. Now we will get on to the questions which we have got for you and me.
Sure.
So let's look forward to let's see those questions and try and answer as best as possible.
Thank you, Dhiren and Shravan. This first question comes from Shreya. She asks, when and how should one decide if it is the right time to exit a fund?
Okay, I'll take the first part of this answer, and then I will ask him when does he exit from his investments, because okay, uh, because Shravan is the right person, because he also has to sell a fund when he has to sell, unlike other fund managers who sell their stocks, and their answer will be very different. Uh, First and foremost, Shreya, that when you meet your goal, if you are investing for a certain objective, let me give you an example. If you're and most of our objectives, if it is a goal oriented investment, most of our objectives can be broadly divided into something which is negotiable and something which is non-negotiable. If it is a non-negotiable goal, then you have to methodically plan your exit. Your child's education 2 years from now, higher education, take a part of it, start redeeming it 2 years before that, or maybe 3 years before that, the first year's tuition fee. Put it in a fixed income fund. You will have peace of mind. Then there are some goals which are negotiable. You want to buy your house, and you want to buy your house in next 1 to 3 years or 5 to 7 years. And if you are investing and suddenly you realize that you have been investing 50,000 rupees a month for accumulating that down payment, and because of a good market it has happened right away, take your money out and go ahead and buy that house. Of course, do your diligence, make sure that you will be buying the house, you will get it. But all I'm saying is that when you plan your investments, the non-negotiable goal, if you get it early, go ahead and do it. You succeeded. So these are two things which is internal to you. The third thing is that when your funds stop being the fund for which you choose a fund for a certain reason. It was doing consistently better than other funds. It was reasonably diversified. It was managed by a person who was actually delivering these things. So if any of these things changes, worry about it. If the fund stops being relatively superior performer, and that was the reason why you chose that, but give it some time. Don't do it on a quarterly basis. Do it on an annual or 2 year basis, because sometimes those numbers could be misleading. If a fund manager changes, worry about it. Think about it, because mutual fund is something where the fund manager plays a significant role. So consistently poor performance, or and many a times your role changes. If you are actually moving your money 2 years before you need the tuition fee, you take your money out from the equity fund and put your money in the fixed income fund. Now Shravan, that bit,
Yeah.
when do you sell a fund, when you get disenchanted with a fund
Yeah.
and you sell it?
So I would broadly agree with whatever you said. So if there is a change in a fund manager, go and evaluate a fund manager to see who is taking over the reins. If he has a history behind him, then I would stick with the fund. If there's no history, take out the money, go to somebody else, and if he's proven himself again, we'll come back. Change in mandate of the fund, which you have explained. Thirdly is change in style of the fund. Sometimes what happens is the fund manager is doing well. There is a style which accrues primarily because of, let's say, the laxity or the hubris which comes in. So that's where I become very, very watchful in terms of what stocks is he
Yeah,
buying and
of
what is
late
he
I have
buying.
also seen that a lot of funds actually turn big and then
Right.
they are unable to conduct the way they used to.
Absolutely.
Do you face this problem very often?
Absolutely, that is one of the problems which we have. So that's when you have to evaluate the alpha. So as I said, satellite. So that's where alpha gets from, where I get the alpha from. So if there's an opportunity cost, which is another fund which can do well compared to this particular fund, which is deviating from its style, then I would go into the other fund. So these are the various, various reasons why I would change a fund.
Moving on, this next question comes from Anoop. He says he retired last month and he asks if it is the right time to invest his PF money in debt funds in lump sum. And further on, he asks what could be the right type of fund to invest his 20 lakh rupees.
I will partially answer this question that Anup should invest in all his money in fixed income, debt funds, only if he has, he's extremely conservative. He doesn't want his money to go down in value even for a few days. But there is a cost to it. Your ability to beat inflation over time. If you consume all the income that you derive from this, your capital value will go down. So if you invest 20 lakh rupees, maybe if it is going to generate say 8% today, I'm just giving you an example, don't expect 8%, but assuming it is getting you 8% today, so your earning will be 1,60,000 rupees a year. 5 years down the line, your need for higher income because of rising inflation, even if it be at a lower rate, if you have consumed all the capital, the 1.6 lakh rupees which you will earn from these funds, that will remain constant. Your 20 lakh rupees will remain the same. So you need to really worry about protecting the worth of your capital, and that is why consider as some allocation to equity and do a careful evaluation of how much money you need every month. Do you have any other primary source of income, whether it be a pension or whether it be a rental income or something? And then invest in fixed income only to the extent that you necessarily need money that every month. Rest of the money you need to assume some risk to ensure that the worth of your capital is protected. Now for a person like him,
Yeah.
for a person like Anu, what kind of debt fund would you suggest from which his primary objective will be to ensure reasonably good return from fixed income with reasonable stability?
Yeah. So the couple of categories which we touched for him, because he doesn't want to see the upward movement, downward movement of the NAV on a regular basis. So I would suggest 50% of his fund has to be in credit funds, and maximum of 50%. That will provide him low volatility and a higher return over a period of time. The rest 50% has to be there in the short term category of funds. Again, the yield which you get is similar to that of FD funds, with a better taxation which is available. But I completely agree with you that it should not be totally debt, for a retired person. It depends upon what his cash flow is, and
His
what is
income
his need,
requirement.
what his requirement is.
This next one comes from Dr. Das. He wants to know if it is a good idea to book profits in 1 to 2 years' time when the markets are high while still continuing with his existing SIPs, Thiren.
This is trying to formulate your own asset allocation plan. It may not be a good idea because markets are cyclical, markets are unpredictable. Sometimes and it is very difficult to define the periodicity of these cycles. For last 1 year, everybody has been waiting for the correction, and it has not happened. The market is up 30%. If you would have taken all your money out, you would have missed this. So I think there is a methodical way of doing it. If you if you pre-state your asset allocation, that you will be 20% into equity or 80% into equity, 20% into fixed income, even with your long-term investments. And do your asset allocation for the first time, do it annually so that it is tax efficient. And subsequently, as your assets, as your investments get older, then you do it on a maybe more frequent basis, exactly what Shravan was saying initially, what he does for his funds, which is, if the asset allocation goes wacky, goes completely out of whack for, you had decided that it is 80% into equity, 20% into fixed income, and that 80% becomes 85%. Then, you take money out from your equity, move that money into fixed income. You will be able to rebalance it, realize a part of your gains. But your allocation should depend on your investment time frame. If you are investing for 10 years, 15 years, 20 years, 25 years, then I don't think you need to worry about, because markets will always be like this. They will be in a state of shock, or they will be in a state of exuberance of the kind that we are seeing, and it is very difficult to predict when things will come. So devise your plan, write it down, put it on a board, and make sure that you are following it. If you do it with rigorously, and even if you do it less rigorously, if not 3 months, if you do take a look at your allocation every 6 months, you'll be okay. You will not miss out on any of the big things. If somebody would have done this exercise through the worst phase or the most scary phase of the market in 2002, or 2008, or even earlier, one would have, by virtue of his discipline, of course, SIP, it goes without saying that you should carry on. In fact, to derive greater advantage from your SIP, most of us think in terms of a constant money. Increase your SIP amount with your rising income.
Moving on, Kamlesh says that he has recently invested rupees 1 crore in a single fund for long term, expecting a return of 26% per annum. Is it the right step?
If you have invested 1 crore rupee in a single fund, make sure that you are going to be a long-term investor. I strongly urge you to moderate your expectation of 26%. There is a possibility that some fund might give you 26% return over some period of time, and particularly more likely over a longer period of time. But 26% I am worried about, because 26% is a very high return. It almost amounts to tripling your money every 3 years, somewhat, and so doubling your money every 3 years. But I would say that if this turns out to be if not 26%, if it is 18%, don't be surprised, because and you need to necessarily moderate your expectation for 2-3 reasons. The past return that we have seen in India is entirely because we had very high inflation. That is why we had very high fixed income rate, the bank rates, the deposit rate on which you could have made a deposit 15 years back or 20 years back was nearly 12%, 13%, 14%. If you were assuming risk, then it could well have been 15, 16%. Those times are gone, and for the first time in last 2-3 years, we are witnessing a government and the RBI which says that they are targeting inflation. Just like the terrorists, they are targeting the inflation. So so times are changing, and if inflation comes down, fixed income comes down, equity returns are bound to follow, and that doesn't mean that it will be low return. If you will get 15% return from equity, that will also be equivalent of 25% return from equity in the past. So keep that in mind, and investing in 1 or 2 fund is not a bad idea. In fact, having too many funds often leads to unnecessary diversification.
This next question comes from Mr. Mangaonkar, and I'm sure a lot of our viewers would just love to get answer to this question. He asks, what type of fund would you recommend for a bull market and what type for a bear market?
I think I will leave this question to Shravan.
No, it's tough to know
You have
whether
been
in a bull
smiling
market.
for a while, so I thought I'll give you a hard question.
So it's very tough to know whether in a bull market or a bear market. Typically, you come to know that you're in a bull market only after 2 years get passed. So it's very, very difficult to allocate money based upon bull market or bear market. So I would, my personal favorites are, do major chunk in large cap funds, be in multi cap funds. But if you still believe that you are in a bull market and you want to run it, then the places to go are mid cap funds and small cap funds. That's where significant alpha will get created. For a bear market, if you want to invest, then it's going to be closer to benchmark or value funds. So these are the two kind of categories which you can select your funds from.
I reasonably agree with him, but at the same time, it's very hard. I think more important than these funds, your ability to anticipate that we are going to get into a bear market or we are going to get into a bull market while we are in the bear market is going to generate the highest alpha, because and if you are able to figure that out, then I think you can do many other things than just invest in mutual funds.
So I think it'll be interesting, Dhirendra. Let me just share one tidbit. We've done an analysis where if you just remove 25 days for the last 25 years, where greatest returns have been made, the returns are below the savings rate return. So most of the people, what they do is they remove the money at wrong times, put in the money at the wrong times, and end up making the experience returns are different from the returns which are posted, marketed. So I would rather believe that one has to be very, very careful in going in and out of funds, to generate wealth over a long period of time, because Indian markets for the last 20 years have generated between 18 to 20% CAGR. So even with muted expectations, I think a large amount of money can be created.
Yes, I completely agree with you that timing is a loser game, and if you are actually going to earn less than the savings rate if you knock some of the key days on which, because markets actually go up or go down substantially when you least expect it, and only a long term view can mitigate that.
Next up, Girish asks if equity savings funds are a good option for conservative investors.
Yes, they turn out to be, the kind of person, we were talking about Anup, and if that large fixed income investment that he plans to make, if he's not going to depend on that investment for regular income, then these are going to be very useful thing. Two reasons. One is that you get an allocation to equity which is conservative, normally 25 to 30% into equity. That is useful for protecting the capital worth of your capital. Second is tax efficiency by its design. The more equity income fund, because many of them are structured in a manner that they invest 25-30% of their fixed income allocation in arbitrage opportunity. So from taxation point of view, they are treated as equity fund. Yeah. So they seem reasonably okay for,
absolutely,
but not for guaranteed fixed income. Yeah. Once in a while, because that 25-30% allocation to equity, it will be almost like your conservative plan.
Yeah. No, absolutely, I agree with you. It's a development over conservative plans, and put in the arbitrage for tax efficiency. If somebody is looking at 1 year plus with a conservative outlook, I think those are great schemes to invest in.
Moving on, Ganesh asks if there are any guidelines or resources to assess a new fund manager.
How do you go about evaluating a new fund manager? The public information is that where he has studied, and value research will go and actually do an interview that where he comes from. But normally nowadays, Ashutosh, what I find is that most fund managers, they are, because now there is a large cadre of fund managers coming up, so they would have worked as an analyst. So what is your, how do you?
No, absolutely. Go and have a chat with him, or if not chat, interviews about him. Go and talk to people who have worked with this gentleman who is a new fund manager. Then the plethora of information which comes from that. Typically, I don't invest in a fund manager until proven on a NAV basis, which is published. But if I were to do it, then I would use this methodology of where has he studied, what has he come from. Just have a chat, how smart he is,
how does he think,
how does he think, does he stick to the mandate, so these kind of things which subjectively which comes in.
And you may dislike him, but he might turn out to be a great fund.
He might come, turn out. So that's why data. What you see is God. So I would wait for 6 months, 1 year for the data to prove me incorrect in that case. But if I were to judge initial go, these are the ones subjectively.
We'll take one last question for today's edition of Investors Hangout. Kuljit asks what the ideal diversification for his funds should be to make his portfolio immune to the market. Is it really possible to make one's portfolio immune?
Yeah, what do you do?
No, that's a good question, but it's an element of probability which you need to come with. So let's assume a case where markets can correct 20%, but still you want your principal to be safe. right? So X allocation which you give it to equity, 20% correction. For example, if you give 30% allocation to equity, there's a probability of 20% correction 1 year, which means a loss of 6%. Can 70% of my portfolio make 6%, so that my principal is equal? So 70% yields 8%, which will yield you about about 5.6% or 5%. Then you tweak it. So 25, 75 is something which you do. So that's about what you go with it. Completely Indian, you want to make money when fund makes money. You want to not make money when fund doesn't make money is something which I think is not possible. However, the other strategy which you can look at is the dynamic asset allocation funds which have come up. Again, the beautifully run funds across various fund houses. They invest, when the PE, they increase the exposure to equity when the
So
PE
they
is at
follow a model
follow a
of asset
model.
allocation.
Yeah, so that is something which I think I highly recommend if you want to play multi-year cycle, wherein you are investing higher when the PE is lower and investing lower when the PE is higher.
Yes. So this is what you can do about your asset allocation. People are getting scared. People are also getting greedy. People are trying to benefit from the big exuberance we see in the market. At the same time, many people are worried, and that is what we see in all these questions. Do your asset allocation. Be methodical about it. And I don't think the biggest alpha generator for most individual investors is their own discipline. And if you're disciplined about it, some of the fund managers, even if you go wrong with them, you will benefit.
Thank you everyone for joining in. That's all we had time for today. I hope you enjoyed this conversation.
Thank you.